So why is it important to be discussing qualified opportunity zones now in 2026 when the original legislation was in 2017?
So back in 2017, when they rolled out the Opportunity Zone initiative, there was a caveat in there that you could defer the gains, but only until December 31st, 2026. So the tax comes due, you kind of need to know, what money you need to pay for that tax.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hantzmon Wiebel. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. Today, we are joined by Kendra Stribling, a partner in our tax department. Thanks for being here, Kendra.
Thanks for having me, Clarissa.
Can you tell us a little bit about yourself?
I am a partner in the tax department. I've been with the firm for going on 28 years. I specialize with closely held businesses and individuals, work in the real estate, agribusiness, and multi-state areas.
So today we are talking about qualified opportunity zones. So we're going to talk a little bit about the basic rules, but also some recent changes that have been made. So at the core, at the basics, what are qualified opportunity zones?
So qualified opportunity zones are low-income tracts that the government established back in 2017 under the Tax Cuts and Jobs Act. Basically, tracts of property where you could invest capital, start businesses, and do real estate businesses as well. The qualified opportunity zones are a great incentive for business owners or individuals who had capital gains that they didn't want to pay tax on. They were able to make an election to defer that gain into the future by making investments in qualified opportunity fund businesses or real estate.
So back into those low income areas.
Yes. So again, it had a lot of detailed rules and provisions that you had to go by, but ultimately if you made an investment in the initial years, you would qualify for like a stepped up basis in the property, and then you would, if you hold it for 5 years, you'd get like a 10% step up. If you held it for 7 years, you would get another 5% step up in basis, so that when the tax became due, you'd only be paying tax on the 85% of that gain, not the full 100% that you deferred. So you kind of get, minimum 7 years of interest-free, loan from the government, basically.
So why is it important to be discussing qualified opportunity zones now in 2026 when the original legislation was in 2017?
So back in 2017, when they rolled out the Opportunity Zone initiative, there was a caveat in there that you could defer the gains, but only until December 31st, 2026. So 2026 is the year that, the tax year that any investors who made those investments would have to recognize the gain on their 2026 filing, or be ready if you're going to have to extend a return April 15th of 2027, the tax will be due at that point in time. Basically, if you made an initial investment, say 2019, you'd meet that seven-year holding period. And so if you put in $100,000, you'd be able to have a 15% step up. So you'd only be paying tax on that $85,000 of gain that you invested. So again, kind of a step up in basis, which is nice. So the tax comes due, you kind of need to know, what money you need to pay for that tax, but also, you don't want to probably mess with that investment. You want to make sure that investment's still going, because the biggest factor of that qualified opportunity investment is that it can get another further investment in where you don't have to pay tax after 10 years. So like you pay the tax in 26, but if you held it another 3 years, there's all that appreciation from your initial investment on is not subject to tax. So that's kind of the big win, is that after 10-year investment holding. So again, got to pay the tax today, but you can continue to invest in it for a few more years and hopefully come out, a big winner.
So one of the original provisions was that you had to make an investment within 180 days. Can you please elaborate on that?
Sure. So the provisions for the qualified opportunity zone investments were, if you had any eligible gain and that would be eligible gain from sale of real estate, sale of stock, sale of another business, to like an unrelated party, third party. You could defer that gain, and the investment in the Qualified Opportunity Fund has to be done within a 180-day period from the original date of sale, when the gain was calculated, or that's kind of in the basic rule. If you're an individual, say you sold stock, 180 days from the date of the stock sale, you make that QOF investment. Partnerships are a little harder or more complex, I guess, with the rules, because the 180 days can be calculated in multiple ways. It could be 180 days from the day the partnership sold a piece of property or a business, or it could be the end of the partnership year. So calendar year partnership would be December 31st, or you also have until the filing of the deadline. So if the partnership return is due March 15th, that could be the time frame that you use, and so then you'd have 180 days from that. So there's definitely more leniency as to what date you actually use in a partnership or pass-through entity when you have gain coming through there.
Yeah, and that's really key to this provision.
Correct. Yes. Yeah. Yes.
One of the more recent changes to the qualified opportunity zones occurred in 2025 via the HR 1 bill. Can you talk to us more about that?
Yes. So the original Qualified Opportunity Zone investment was geared towards sunsetting at 12/31/2028. With the bill that they passed in 2025, it basically made the Qualified Opportunity Zone investments a permanent incentive for taxpayers. So still has some similar rules, but there's no longer that standing 12/31/26 date for recognizing gain. Basically, it ends up being a recurring kind of timeline. So you make the investment in a new Qualified Opportunity Fund, and then you would have to recognize that gain after 5 years. So it's kind of a rolling average. You still would get a lot of the benefits. You would get a 10% step up in basis if you held the investment for at least 5% or 5 years, excuse me. And then basically it still has the permanent incentive, or the permanent, where you could not pay tax on any future appreciation from the date of your investment on if you hold it at least 10 years. So again, a great benefit for those that are interested in holding real estate for long-term timeline.
So a great tax planning tool.
Yes. And then some of the other kind of provisions that it did put a 30-year kind of sunset on it. So, long-term holdings, that if you held that Qualified Opportunity Fund interest for 30 years, like that would be the date that you'd have to, kind of be the end of the holding period. Like that's whether you've sold it or not, you'd have to kind of, recognize the fair market value at that date going forward. So it kind of has a little bit of timeline, but again, not a tax, issue there, other than the fair market value gets slated at either the time you sell it after 10 years or at that 30-year time frame. The other thing that the new act implemented was a new rural opportunity zone. So basically any zones that they end up establishing that is in a rural area would actually get a 30% step up in basis versus the 10%. So definitely some opportunities there for agribusiness and the agricultural businesses and investors that are interested in that. So that's a new feature. And with the new rules, if you had a legacy Qualified Opportunity Fund investment, those don't follow the new rules. They will still, like I said, stay under the old ones, where they will kind of have their same holding period, and again, 2026 recognize gain, and then hold for the 10 years or more.
So stepping back, big picture, what does this mean for real estate investors or other business investors?
So it means that this year, 2026, that you just need to, if you've already invested in a Qualified Opportunity Fund, you need to start working with your accountants, planning for how much your tax bill will be for the coming year, and get ready for the April 15th extension or tax due at that point in time. If you're an investor or you're anticipating some large gains, some meaningful gains in 2026, it's still an opportunity to look for other investments, closely held businesses or some kind of real estate investment. Your broker or investors or financial advisors may have opportunities for you to invest in, so you can look for investments in ways that you can take advantage of this new opportunity in the long term. And then, don't forget too, like I said, the qualified investments in the rural areas is a new feature, so we don't have a whole lot of guidance out there yet, but it's definitely a time to just, again, start reaching out to us or your advisor and just finding out more about the opportunities that are there and how that may come into play and help you in the future for whatever your businesses are that you are looking to invest in. Sometimes there's ways, if you are already kind of getting ready to plan one, you may still be able to benefit with these rules. So just because you already have something in the works doesn't mean you're automatically out, but it's definitely worth asking questions and finding out more to see if you qualify, and then what you would need to do to, again, make it apply to your situation and benefit, make a good deal a better deal by using the Qualified Opportunity Zone investments.
Well, thank you so much for sharing your knowledge with us today.
Well, thank you. I appreciate you having me, Clarissa. So do you know what your next topic will be?
Well, it depends.